And today we are going to look at something very famous or widely traded nowadays is option trading. Indian derivative market, if you are aware, has become one of the biggest derivative markets, and options especially is become highly liquid because many people who do not have capital have started trading in options, especially the out of money options. If you are buying out of money options, it's like you are trying to catch a train which is running at a speed of 100 kilometers per hour. So you are trying to do that. So out of the money options is something like that, because if you are getting into an out of money option, buying that option, you are not going to make money very often. You are only going to make money 10% of the times, and rest of the times you might possibly lose, because the inherent nature of that option is such that the time value deteriorates, the number of uh, days that are there as it nears the expiry, you start seeing a lot of deterioration. The volatility impacts, the interest rate impacts, a lot of things that start impacting the option price. But given that this instrument is so widely now, it has become like a craving for everyone to understand that. So that's not a bad idea, because if you understand the instrument well, trading using options can give you a lot of leverage, can give you a lot of money. Uh, Especially if you're writing options, you might still make a lot of money. So a lot of things are going to be there. So in today's session, especially today, I thought we will be covering options. So what are options essentially? Okay, theoretically, if you read, you will be able to understand that options offers you the right to exercise, and for the option buyers, they can exercise the option and all those gyan. But in the current market context, in Indian market, there is no European options. It's all, if I'm not mistaken, it's all American options, which can't be exercised during the period, but it only on the expiry day. So that's how it's going to be happening. Yes, Omkar, that's absolutely fine. Okay, it's European options we are following. I'm so sorry. American options we are not following, because American options can be exercised during any day. European is exercised only end of the month. So I'll come to that. What is exercise and what does it mean and things like that. Let us first understand one thing in a very simple language. Suppose in a market you went for uh, buying 100 kgs of potato. I know this might look a little lame, but it's easier to understand when we have a real life example. For your marriage, or for your son's marriage, depending on where are you in your life. So 100 kgs of potato you wanted to book for marriage, which is going to happen after 1 month of time. Now you don't have a warehouse right now, and you don't want it right now. You want it after a month's time. You don't want now 100 kgs of potato. You need after a month's time, because right now it's not required. So you go to the vendor, and once you go to the vendor, you ask what is the price. He says currently it is 100 rupees per kg. Sorry, this is 100 kg. It is 10 rupees per kg. Currently it is 10 rupees per kg. So you say, okay, I don't need it now. I might need it in the future, which is like after a month's time. So he says, no, if you need after a month's time, then I'm not going to give you at 100 rupees, 10 rupees per kg. I will be then giving it to you at 12 rupees per kg. Why? Because after a month's time, there is monsoon going to start and the prices are going to go higher. That's why the price now is 10 rupees, but after a month, it's going to be 12 rupees. That can be one of the reasons. The next reason can be, since we are blocking it now, I don't want to take the risk for a month's period. Suppose if the prices go up and I give it to you at 10 rupees per kg, then I don't want to take that chance. So the risk associated for me is worth 2 rupees. That's why I want 12 rupees. So that is another way of looking at it. That's the risk factor. That's the uncertainty for holding it for you for a period of month. That's the uncertainty. Now, given this, you say, I'm not going to give you the entire amount. What if tomorrow you runs away? And he says, I'm not going to block it just because you don't give me anything. So why don't we come to a conclusion? The total cost of the contract. So this is the contract we are entering now. This is known as a forward contract. Forward contract means that we are entering into a contract. What is a contract? In simple language, on a piece of paper, you are writing down the conditions. In a forward contract, you are entering that the total value of this transaction is worth 1,000 rupees. Okay, that's the contract value. This is known as a contract value. Okay, the lot size of this contract, say this is 100 kg, is assumed to be one lot. One lot. So instead of saying 100 kg, 1000 kg, 10,000 kg, it becomes too big a unit. It's very similar to, you say, instead of meter, millimeter, you say meter or centimeter, so that it becomes easier. Same stuff here. Instead of saying 100 kg, I'm saying one lot. So we are entering into a contract of one lot, which is worth 1,000 rupees, and as of now. But in the future, he's expecting it to be 12 rupees. So you are entering into a contract not of 1,000 rupees, you are entering into a contract worth of 1,200 rupees now. So your spot price becomes 100. Your future price becomes 100 and sorry, your spot price becomes 10. Your future price becomes 12. There is also an interest element here. What is an interest element? In a month's time, you might be making something out of that, right? That is an interest. That's why the forward value is adjusted by looking at an interest, by looking at the risk, by looking at the uncertainty. So all these factors affect the value of futures contract. What is the difference between futures and forward? Futures contract is traded in exchange. Forward contract is traded on the counter. On the counter means what? Between you and me, in a closed thing. There is no legal exchange involved in this. Okay, that's the difference between futures and forwards. Is it clear so far, everyone? OTC, over the counter, right? So far so good. Are you in sync? Again, I'll repeat. My spot price is 10 rupees. My futures price is 12 rupees because there is interest rate risk. There is uncertainty. That's why if I enter into a contract now along with my vendor, it's called as a forward contract. In that contract, the contract value is 1,200 because the futures price is 1,200. Spot price is 10. And the lot size is one lot. One lot consists of 100 kg of potato. Now, you tell him that I'm going to give you out of 1,200, I'm going to give you 10% as margin. 10% as margin. Okay, which means I'm going to give you 120 rupees. So 1,200 into 10% is what you are going to give you as margin. So that is known as a margin amount that you are paying to the vendor. Now the vendor is secure. Why? Tomorrow if you don't show up, tomorrow if you run away, you don't show up, he has this 120 rupees. So in case potato prices goes down also, he is still having that much of certainty that he can go and sell it to someone else. So he is secured. From your perspective, you had no money, you ran away, so you lost this much of amount and it's done. So the contract gets void. Done. So you don't have to bother. Same stuff. So tomorrow, if you are dealing with Nifty, you don't pay the amount to the other person. The exchange can square your position. This is known as margin. This margin amount is debited directly from your account. However, there is something known as mark to market, which is also known as MTM. Now, mark to market indicates that if you want to enter into a contract, so 120 margin I should be having every single day. I'm not going to compromise on this margin amount. So every single day, my margin amount will be 10% of the contract value. So the margin will keep going up or down. So it will keep changing, but not very drastically depending on how much it is moving. Suppose if this position goes against you. So for example, right now from 12 rupees, the price of futures now become 9 rupees. Now the price of futures become 9 rupees. What will happen? You have lost essentially $3 on the specific contract. Now if you have lost $3 on one single potato, 1 kg of potato, on 100 kg of potato, you have lost 300 rupees. So the vendor will come to you and say, today you give me 300 bucks. I have your margin. Margin will also change to an extent. But suppose the margin is constant for now, 120 for now, just for calculation. So your margin is this much, but this margin is very less to take care of your M2M. So you need to ensure by the end of the day, you come and give me my mark to market, which is your loss, which is 3 rupees multiplied by the lot size. That's the mark to market. But suppose if the contract goes from 12 rupees to 15 rupees, now my mark to market, I have to give it to you. The vendor has to give it to the buyer. That's how the mark to market keeps changing daily. Does it make sense? And this is how the futures world move. This is futures, not options. Am I being very clear? Why you have to pay mark to market? Why it gets debited from your account? Why it gets credited in your account every day? And why the margin amount is different? This margin is calculated using various methods, which is known as value at risk, parametric one. So I worked. The reason I know this in and out is because I worked with a National Stock Exchange. I worked with National Commodity Exchange, NCDX, where we were doing all of these things in Excel, calculating the parametric VAR, calculating different ways in which the value at risk is derived, deriving it in Excel, coding everything, coming out with a fair value, coming out with a Black-Scholes model, lot of those things we were doing. So that's how the entire functions of future and forward works. Does it make sense? Shall we continue with these things? Or you want me directly to jump onto the application? Every one of you, are you able to hear me? Shall we continue with this concept on options now, how it looks like? So I'm not going to spend too much time, but it is important for you to understand, because once you understand, you know how to go about it. So I'm going to be very clear about the options. Let's move on to the options now. I'm going to remove these things and let's move on to the options. Okay, let's just do that. Now, once we go to the options, how are we trying to see this thing? Similarly to futures, the options are such that you go to the vendor, the price of the potato is 10 rupees per kg. One lot consists of 100 kgs. And now you say that, now you tell him, I'm going to give you 2 rupees, not as a margin. I'm going to give you 2 rupees as a token. There is a difference. I'm giving you 2 rupees as a token amount. If I'm giving you 2 rupees as a token amount, by the end of the month, I will come, I will pay you the balance amount, and I will take away my goods. So I'll take away 100 kgs of my whatever goods I have. I'll pay you 10 into 100, which is 1000 rupees. And take that with me. Now, over here, there is one more thing that gets added. 2 rupees is what you have given him as a token. Okay, 2 rupees is what you are not giving is as a margin. You are giving it as a token amount to him. End of the month, you will give him 1000 rupees. Now, there is a difference here. Let's introduce the concept of a strike price. You say that at the end of the month, I'm entering now into a contract again. I'm entering into a contract with a strike price at 9 rupees. Okay, with a strike price at 9 rupees. Tell me Do you think the vendor will enter into a contract with a strike price of 9 rupees with you unless he has some benefit out of it? Why will he enter into a 9 rupees with you when the current prevailing price or spot price is 10 rupees? When the prevailing spot price is 10 rupees or 10 points, why will he enter into a strike of 9? He will enter into a strike of 9 only if you give him the difference amount also right now today. So this is known as an intrinsic value. The intrinsic value becomes 10 minus 9, 1, which means this option, this is known as a call option. So the options are divided into call and put. The intrinsic value of the call option is 1 rupee. Intrinsic value, which means suppose I have an option to exercise. Exercise means what? I entered into a contract of 9 rupees. And today itself, I'm exercising my option, which means I have the right to sell this at the market price. I entered into a contract at 9. What is the prevailing market price is 10. So if I immediately buy at 9 and exercise it at 10, don't you think I have a windfall gain of 1 rupee? Is there any free lunch in this world? No. Which means your option price should be at least 1 rupee. If your option price is at least 1 rupee, which means you have paid 1 rupee already. And now if you exercise it, a 9 rupee strike price, you get 10 rupees, which means you have to pay 9 rupees. You get 10 rupees and 1 is already paid. I'm again repeating. Exercising an option means what? You can pick up that good and sell it in the market price. So you pick up the good at 9 rupees, you sell it at 10 rupees right now. So there is a windfall gain of 1 rupee, but there is no free lunch. So you can't really have a windfall gain, which means that to buy this option contract at a 9 strike price, I need to pay the intrinsic value of 1 rupee to the seller of the contract. Are you with me? Are you getting the entire point of option now? I want to understand so that I can continue accordingly. If I enter into a contract which is of 9 rupees, I have to give seller at least 1 rupee because the spot price is 10, which means the intrinsic value is what? What is the definition of intrinsic value? The definition of intrinsic value is spot price minus the strike price. This is per kg I'm talking. For the lot size, then you have to multiply it by the number of kgs. So 100. Yes, 1 into number of quantity. Who decides 9? We or the exchange. Suppose if you enter into a contract of 8 rupees, you buy at 8 and you can sell at 10 now per kg. You have a 2 rupees windfall gain, which is not allowed. So the option price should be at least how much? 2 rupees, which means you give 2 rupees to the vendor. He will enter into a contract of 8 rupees. Even if you exercise, 2 rupees is gone. The vendor is not going to give it back. This is not margin. The 2 rupees is gone with the vendor. And now if you exercise your option, you are buying it at 8 rupees, but you have already paid 2 rupees, which means you are ultimately entering into the value of 10. Exactly. So Pooja is saying, so today you are going to pay only 1 rupee and 9 rupee payable if you exercise the option. Brilliant. Or 9 rupees payable after a month, up to you. So if you enter into a contract now, you are paying only 1 rupee to the vendor, 1 into the lot size. So lot size is what? 100 kg. So you pay 100 rupees to the vendor. Either you exercise the option during the month or by the end of the month, it's by default you have to exercise. Okay. Since in Indian system, you are practicing European option, you cannot exercise it during the month. Now tomorrow, if the potato price, 1 rupee is paid to the vendor, yes. So if the price of this specific good now comes down to 5 rupees, price of this specific good comes down to 5 rupees, will you still go to that vendor and you are going to buy it at 10 rupees because your contract suggests that you are going to buy after a month at 10 rupees? Will you still go and exercise that option to buy at 10 rupees? Will it make sense for you to do that? Absolutely no, right? Because you will not pay 10 rupees now since the price is 5 rupees. So what will you do? You don't do anything. You run away. What did you lose? When you entered into a strike price of 9, what did you lose? You lost 1 rupee, which you have paid to the vendor. But you saved how much? You saved how much from 10 to 5? You saved 5. Are you with me? So ultimately it's 4 if you subtract. So that much is what you saved, right? Because you were contracted at 9. Am I making sense to you? That's why entering into an option will make a lot more easier. If tomorrow you get carried away, you know the max loss you are going to have is the premium that you have paid. So this is known as an option premium that you have paid to the while entering the contract. You are not going to lose more than that. No one is going to come back and ask for more from you. That is what you lost. But here comes the catch. The option is not only trading at an intrinsic value, it's also trading at a time value. Which means that if you are entering into a strike of 9, that's the strike price of 9 rupees, you are going to pay, spot price is 10. You are not going to pay only 1 rupees, which is an intrinsic value. You are also going to pay 0.5 or something, which is known as a time value. The time value depends the number of days till expiry. So if there are 30 days to expiry, the time value is 0.5. If there is 10 days to expiry, the time value is 0.3. If there is 1 day to expiry, the time value is 0.1. But you will be paying the time value also, which means that if the number of days keep passing and the stock price does not move much, you keep losing. So if the market is not trending, you lose still, which means that if you entered the contract, suppose you entered Nifty contract at 14,500 and after 20 days also it is at 14,500, you lose. That's the catch. Okay, now it's not only this much. Let me just save across the screen for someone who would like to refer it later on. I'll share this across. Now there is a catch more. So the option value is defined not by just 2 parameters, it's defined by 5 parameters. Which 5 parameters? Spot price, strike price, okay, interest rate, time value, volatility. So these are the 5 parameters which was deciding the option price. It has to be put into a Black-Scholes formula. I have actually designed all of these things in an Excel. So you put that these basis of there is a very complex formula. You put this parameter, you will get the fair option price, which should be the ideally be quoted in the market. However, spot price, strike price, interest rate is prevailing 3%, 4% something, time till expiry, time till expiry is 30 days, 5 days, 10 days, is what You don't need an Excel currently. There are a lot of option calculators. So you can simply search for option calculator. You'll get all of those things. Interest rate prevailing, you can check it on the exchange, how much they are taking. I think 4% or something they might be taking. You can check it. What is the current risk-free rate of return? 3.5. What is the repo rate? 4.5. So interest rate is risk-free rate of return. Yeah, average of 3.5 and 4.5, it's 4. Perfect. So that's the risk-free rate of return. Now the problem is the volatility calculation. Volatility keeps changing. Now you don't really know what the volatility is. So what we do is, there is another way of looking at it. The concept of implied volatility. What is implied vol? Implied vol means that I'm putting on the left side of the equation is the option price, which is the current market price of the option. I put all of these parameters and I derive volatility out of it. So if the volatility is 23, I call this as implied volatility. What is the volatility that market is currently expecting from the option? This is known as an implied volatility. You can simply Google out, you'll get a lot of option calculators there on Zerodha also. Once you know the implied volatility, now suppose tomorrow the implied volatility goes down to 18, you still lose money in options. If tomorrow it has already 5 days since you bought, you'll still lose money in the option. So the reason I'm telling you about this is, by buying option, you have to race against 5 important factors. If spot price goes down, you lose money. If time value deteriorates, you lose money. If volatility goes down, you lose money. That's why making money is easier when you're writing option, because these things are automatically in your favor. For example, I'm going to now share across practical example. So this is known as a call option. So if I select a strike price of 8, I pay 2 rupees as intrinsic, I pay 0.5 as time value, so my option price becomes 2.5. Assuming the spot is 10. If now Nifty is quoting at 14,800 and I buy a call option of 15,000, call option at 15,000. Now 14,600 if I buy, 200 is the intrinsic value, but out of money. This is known as an out of money option. If I buy this option, the only value that I am going to give is a time value, because there is 0 intrinsic value. Now the time value that I give is say 100 points. So by expiry, if the option is only 15,000, I still lose money. I lose my entire 100. Buying out of the money option and making money from the market is nearly impossible state. Only where 10% of the times you will be successful. Buying in the money option, you can be successful nearly 30 to 40% of the time. Yes, that's the math. That's the statistics. So if you are okay doing that, then you should be trading options, because many things are against you. Is this thing very clear? So when I say writing option means selling option. Instead of buying this strike price option, I'm selling this strike price option. So that's a sell. You become a vendor rather than a buyer. Simply look at it from that perspective. You go to the other side of the table. When you expect a put option, so that these are all call options. When you expect a put option, exactly the opposite. You expect markets to go down so that you can make money out of it. Now let's move on to the practical aspect. Otherwise, people who are masters of options already, they might be saying I'm wasting their time. So let's just look at practical on how these things can be applied. I'm going to open up an option chart now. But does it answer a lot of your queries who had about how to go about options, how to do that, how to see it? There is a classic book on derivative, which is by NSM. It's a very decent book. You can get a lot of understanding from there. So I'm not going to spend time on that. Okay, let's just go and check a Nifty option. I'm going to open up a Nifty 15,000 call option, which is out of the money, and I'm going to share it with you. The book, if you want to read and understand options, theoretically, I'm talking about, not practically. NISM, there is a derivatives module. I think I don't remember the series name, but derivatives module by NISM. It's not a book. NISM is a SEBI institution. Okay.